I am Bill Friebel with Cornerstone Wealth Management, and I want to thank you for joining our Minds versus the Markets midterm election edition. Before I get started, let me answer what could be a question of yours, which is, who is Cornerstone Wealth Management? Cornerstone Wealth Management and Cornerstone Wealth Services are registered investment advisors affiliated with LPL Financial. The firm was started in 2005 and has 120 advisors in 16 states. As independent advisors, many of our affiliates have chosen their own brand, as you can see on the screen. So it's entirely possible that you've never heard of Cornerstone before because you're working with LifeMap Wealth Management or Genfinity or Triada or Steamboat or any of the others you see on the screen. All of our advisors are affiliated with LPL Financial, which is the largest independent broker-dealer in the country, with over 19,000 financial professionals, $1 trillion in assets under management, and 0 proprietary products, but thousands of investment options for clients to choose. How does this all fit together for you? LPL provides the broker-dealer operations and is a custodian for your accounts. Cornerstones provides support, structure, and the scale of being more than just one independent office, which allows your financial advisor to have more time to spend with you. This presentation would be an example of that. At Cornerstone, we have an investment team that manages the Cornerstone Wealth portfolios. The team is headed by Lanny Bao and Karam Naveed. Both are CFAs or Chartered Financial Analysts, which is among the most difficult designations to achieve in the financial services industry. They also hold advanced degrees in finance and economics, and are also computer coders. I highlight the coding because it's a tool that aids in their management process. The portfolios they manage have been compliant with the global investment performance standards for over 10 years, and they manage over 75 different portfolio options designed to meet clients' risk preferences, return objectives, and Lanny and Karam were kind enough to help me put this presentation together. We believe it's important to have an investment process that is defined and repeatable. This means not flying by the seat of our pants or winging it. Our process is our playbook, and it is evidence-based, rooted in fiduciary standards, long-term in nature, constructed for the client's interest, not a business interest, mindful of taking informed risks, ever striving for improvement, and also humble. We think that last one is very important because financial markets can humble even those who think they have control of everything. But we are always mindful of that and always strive to keep that at the top of what we do. If you dig deeper into our approach, we have some core beliefs that guide us. We believe that our investment strategy is superior because it's one that's rooted in steadfast principles. It's designed for investor behavior and based on evidence. We believe it because evidence shows time and time again that investors, when left to their own natural behavioral biases, will make decisions that are often detrimental to their goals. It matters because investors have goals for their money beyond returns, like living a comfortable retirement, funding an education, supporting family causes, and leaving a legacy. Knowing a sound investment strategy is in place to support these goals provides confidence in their financial future. And we think our approach is better, and you'll notice I've highlighted a section there, because our principal portfolio construction seeks to address and mitigate the ever-present behavioral traps investors face and keep them on course for the long term. Our portfolios are designed to be tailored to your needs, goals, and most importantly, your level of comfort with risk. Those behavioral traps will be some of the material we covered today in our Minds versus the Markets midterm election edition. Our agenda today is going to be to talk about the economic environment and the market reaction. We will be talking about the upcoming midterm elections. We're also going to discuss why your brain might be giving you bad advice. And then we'll also discuss how you can make better investment decisions going forward. This year has offered us the opportunity to experience a few economic happenings that we've not seen in over a decade. And quite frankly, none of them have really been all that fun. We've seen inflation go up and stay high. The US dollar has spiked, which in general sounds like a good thing especially if you're a US citizen traveling abroad, but it does effectively export inflation to the rest of the world. We've seen mortgage rate spikes, and that has led to a slowdown not only in refinancing, but also new homes being purchased. We're also seeing the Federal Reserve literally stomping on the brakes of the economy by raising short-term rates and unwinding the Fed's balance sheet. The yield curve is inverted, and what this means is short-term interest rates are actually higher than some longer-term interest rates. This is usually a bad sign for the economy because usually it means that banks are less willing to lend in that environment. Corporations are starting to warn that earnings may be slowing down, and Europe and parts of Asia look to already be in a recession. In recent months, we've seen a significant hot war on the continent of Europe with Russia invading Ukraine. Perhaps even more concerning are the threats of the use of nuclear weapons. Parts of Ukraine are known as the breadbasket of Europe due to the production of wheat and other grains. Russia is, of course, a big exporter of oil and natural gas. Due to the conflict and sanctions, you're seeing both supply shortages and supply chain disruptions at the same time. While there's fortunately no hot war in Asia, you have seen political tensions rising between the US and China. You may have also seen President Biden make news on 60 Minutes when he said the US would defend Taiwan if there was an attack by China. The White House officials quickly corrected this and said there was no change in US policy, but needless to say, this did make more waves in already turbulent waters. China has also been in varying stages of lockdown due to the zero COVID policy, and this has hurt the world's second largest economy, putting further pressure on an already strained global economy. There have been very few places to hide in either stocks or bonds this year. More speculative areas of the market have been hit harder. Some cryptocurrencies have been cut in half or more. Growth stocks with more expensive valuations going into this sell-off have fallen the most. And bonds, which usually hold up very well in times of turmoil, are now down because interest rates have been rising. And I really hope this guy gets some sort of royalties from CNBC, because every time we have a really bad day, I see this stock image of him holding his forehead. And I really don't mean to make light of the turmoil, as it has not been very fun. In fact, it's been quite a bit of an emotional roller coaster. As if the economic and market environment wasn't bad enough, we also have midterm elections coming up on November 8th. Here's what's up for grabs. First of all, in the US Senate, there are 35 seats up for election. 21 of those are currently held by Republicans, 14 are held by Democrats. And we, of course, have a 50-50 split currently, with Vice President Harris casting the deciding vote in ties. So this really is a critical election, which really could determine who controls the Senate. In the US House, there are 435 seats up for the biennial election. So that means all of them. And currently the makeup is 221 Democrats and 212 Republicans. For state elections, for the governor's offices, 36 will hold elections in November. 28 are held by the GOP and 22 are held by Democrat. So let's take a look at some of the top voting issues, which, by the way, if you disagree with the rankings of these, don't blame me. It's from Pew Research as of August of this year. While it might not align with your personal ranking, I would expect that you will find many of your top issues on this list. There are clearly a number of these issues that are very emotionally charged, as we've seen many debates playing out in the court of public opinion, as well as at the Supreme Court. And let's look at a few of those at the top of the list: the economy, gun policy, violent crime, healthcare, voting policies, education, Supreme Court appointments, abortion, energy policy, and immigration. I mentioned an emotional roller coaster both on the previous slide as well as a few slides ago. Remember at the end of last year when the market was at all-time highs? That usually coincides with how we're feeling about our investments. And that may have felt euphoric at the end of last year. Now, after the market is down by 20% or more in some cases, we might feel somewhat closer to the bottom of the trough toward the right-hand side of the slide. Unfortunately, this is where a mettle can be tested, and we can allow our emotions to get the better of us, and we might even be tempted to make short-term changes that can dramatically affect a long-term investment plan. The economy, markets, and politics can exacerbate that ride and heighten that sense of feeling like you need to do something. But is doing something always the right thing? We're going to look at some of the reasons why we do it and some ways that hopefully we can avoid making bad choices. Back in the early 2000s, Dr. Daniel Kahneman and a few other psychologists started working on what is now known as behavioral finance. Today, there have been numerous books on the topics and degree programs at universities across the country. The focus of the material is how we make decisions about money, but also how we are hardwired as humans to make decisions in general. The two ways we make decisions are intuitive, which is about 95% of the time, and reflective, which is about 5% of the time. When you think about this, it kind of makes sense. In the early days of human beings, our main goal was survival. And if a tiger jumped out of the grass with the hopes of eating us, we couldn't really be reflective on the situation. We knew it was bad for us, and we had to respond immediately. However, when it comes to investing, many studies have proven that when people are reactive, they usually are making decisions that are detrimental to their long-term goals. If you don't believe me, just look at the results. Here are actual numbers from the 20-year period ending in 2020 of how the average investor did versus a variety of investment categories. An organization called Dalbar looks at inflow and outflow data of mutual funds to determine when and what investors were buying and selling to determine what their average return would be. You can see that the average investor, which is right here, did slightly better than the rate of inflation over this period, which that is right here. Now compare that to the inflation that we're experiencing now, and they would have dramatically underperformed over that same period. While there are many, many investing mistakes, we're going to put a few into the framework of Dr. Kahneman's work in behavioral finance. Dr. Kahneman had more categories than the four you see on the screen, and this is just a sampling. So let me give you some examples. Anchoring is basically missing the forest for the trees, or focusing on one piece of information as opposed to looking at the entirety of things. Hindsight bias is putting too much stock in what has already happened and not adapting to the environment moving forward. Extrapolation is thinking that what is happening today will continue to happen forever. For example, we will have low inflation for the rest of your life. Well, how's that working out? The last one is what we're going to be spending more time on today, which is availability and confirmation bias. I'm combining the two, but I really feel that they're related in many ways. In an environment where we are constantly bombarded with information, whether it's from TV, social media, print media, etc., availability and confirmation bias are very real risks for investors. We can find information very quickly that will agree or confirm our point of view. Not only can we find it, but there's actually probably an artificial intelligence algorithm pushing it to us. Dr. Kahneman's work would suggest that we always tend to go for the information that is most abundant and easy to retrieve. We also tend to stop looking when we find information that agrees with our point of view. In other words, the average investor rarely does deep, intensive, critical research. Think about that and what it means during an election cycle for just a moment. Here are a few examples of how this might apply to investors. I found a commentator on Blank Network who has the same opinion on oil stocks that I do, and she says they are a buy. The Reddit forum said that GameStop is going to the moon. I heard someone on TikTok say that they went to cash because blank is in the White House. The problem is that the information we have may not be giving us the entirety of the story. We also tend to wrongly put too much weight in things that agree with our point of view, as opposed to leaving our biases at the door. Here's an example of how this works in politics. If you see a poll that agrees with your point of view, the poll is accurate. If you see a poll that disagrees with your point of view, the poll is flawed or the methodology is wrong. Take a look at consumer confidence relative to political affiliation. Election day is denoted by the vertical lines. As you'll see, directionally, the red and blue lines move up or down at the same time. However, Republicans are more optimistic when their party is in charge, and Democrats are more optimistic when their party is in charge. Interestingly, look at the average returns in the box in the upper portion of the slide, which is right here. And you'll see that there were good parties or good periods and bad periods for both parties. So if we are pre-wired to be more reactive and intuitive, and we know this is going to be heightened due to the political season, how can we as investors make better decisions? You see an image of Flight 1549 that landed in the Hudson River. I will guarantee you that the pilot, Sully Sullenberg, did not start the day with a flight plan that included landing in the Hudson. However, there was catastrophic engine failure caused by birds flying into the engines, and he had to make drastic changes. If you and your advisor have developed a plan, unless there's catastrophic changes like a premature death, a job loss, or uninsured disability, stick to the plan. However, that does not mean you don't have to make adjustments along the way. Ask yourself the following questions. Has your goal changed? Has your risk tolerance changed? Have your immediate cash needs changed? Has your time frame changed? Another best practice is to give yourself perspective when digesting the information you're receiving, and ask the following questions. Is this normal? Is this part of a long-term cycle? Are you looking at all the data? And has the market already reacted to the data, the data point that you're using? Now, here's some examples of perspective as it pertains to the upcoming midterm election cycle. First, it's very normal that the president's party typically loses seats in Congress. In fact, as you can see to the far right of the screen, it's quite rare that the party in power, and you'll see that here, it's quite rare that the party in power actually picks up seats. Now, there are many reasons for this, but one is that it's just easier to run as the opposition party. All you have to do is point out the mistakes the opposing party has committed over the past 2 years. And let's face it, all politicians offer ample opportunities for this. Now, we've already had a pretty rough year for the markets as far as returns goes. But looking at the average of midterm election years, they've all tended to be fairly muted until after elections. Midterm election years have also been marked by having higher volatility than other years. We've certainly experienced that so far this year, and you'll see that if you look at every calendar month's average returns for midterm election years versus all others, every month except 2 have historically been a bumpier ride. Here's some possible good news. No guarantees, of course, but returns after midterm elections have been strong, and in some cases quite strong in the 12 months following the elections. In fact, look at the box right here near the bottom of the screen. The average 1-year return following midterm elections have been historically better than all others. We're talking about giving ourselves perspective, and I think this slide is important to digest. Going back to 1933 through last year, stocks have done well regardless of who's in power and the makeup of power. Remember that earlier slide that said, I heard someone on TikTok say, if fill in the blank gets elected, I'm going to cash? Well, chances are that would have been a very bad move based on history. Let's start to talk about why that might be. Let's first look at real GDP. When we say real GDP, it means the GDP adjusted for inflation. You'll see there were strong years of growth when Democrats were in control of the White House and Congress, represented by the blue bars. Strong years when Republicans were in control, represented by the red bars. And strong years when we had divided government, represented by the gray bars. You'll also see that all three scenarios presided over recession when the bars go below the line. Similar story when you look at the stock market. Good and bad markets for all three scenarios. Something to note, if you look at the average numbers in the box to the upper right of the slide, right here, while some are better than others, none are really all that bad and certainly not a reason to change a long-term investment plan. So let's get into the why of the economy and markets tending to do all right, no matter the political makeup of Washington. I want to take you back to Econ 101. You might recall the GDP or output of the economy equals consumer spending plus investment plus government spending plus or minus net exports. When I started paying attention to this stuff a little over 25 years ago, I was told consumer spending made up about 2/3 of the economy. As of the end of the second quarter of this year, it was about 68%. So pretty much dead on where it was 25 years ago. At the same time, meaning the end of the second quarter of this year, government spending was 17.5%, investment was 18.2%, and net exports were a negative 4.1%. While you may disagree with how the current party in power spends the money, the makeup of GDP has really not changed all that much. One party might incent the consumer in the form of tax relief. Another party might incent the consumer by spending on increased benefit checks. One party might spend more on defense, while the other party might spend more on green energy. Either way, it equals GDP. Now, look at this chart. In general, while there have been blips throughout history, the U.S. economy has consistently grown over time. Now let's talk about stocks. The job of a CEO of a publicly traded stock is to navigate all economic environments and allocate the capital of the firm to drive earnings for shareholders. They don't just shut the doors of their company because a new party takes power in Washington. They adapt to tax law changes. They might shift where they are investing. They might move a plant to a more tax-friendly state with a lower cost of labor. They might shut down or sell unprofitable parts of their company. They might open new business lines due to new opportunities. But if you look at the chart, the earnings per share of the S&P 500 has a very high correlation, meaning they move in tandem with one another, to the price of the S&P 500. As long as companies continue to earn money, the chances are good that over time, the price will follow. Regardless of the political environment, given all the uncertainty we've seen in the market and economy, it's always good to give yourself the perspective of realizing we've seen many struggles before. While there have absolutely been times when the market has gone down or sideways for a while, we've made it through those challenging times, and a long-term plan has generally been rewarded. This is another way of looking at it. This is the last 42 years of returns of the S&P 500. The gray bars are the year-end returns. The red dots are how low the market was at some point during that same year. The point I'm making is that declines are normal. Historically, they've been temporary. Let me say that again. Historically, they've been temporary. 32 of the past 42 years were positive. Now, we've been a little spoiled over the last decade, as you can see at the right-hand side of the charts. And let me maybe just highlight that a little bit. So let's look at this area right here. So we, of course, had the major decline in 2008. But since that time, the worst calendar year return since 2008 was only down 6%. Now, this year, of course, could change that. No one really knows. But it's good to give yourself that perspective of it being a normal occurrence over time. As I mentioned at the beginning of the presentation, Part of the Cornerstone Wealth portfolio process is to address and mitigate the ever-present behavioral traps investors face and keep them on course for the long term. So here's what we are doing now. But what's important to note is this is what we are always doing because we stick to our process. Our process is our flight plan. It doesn't mean we won't make adjustments if necessary, but changes are made within a framework based on principles. So right now we are monitoring information on a daily basis, but being steadfast in our defined and repeatable process. We are managing based on long-term objectives. We are not trying to predict what will happen tomorrow, next month, or next year. When we make adjustments, we're looking at all information with perspective. And we look to take advantage of what might be mispriced opportunities based on valuation, not emotion. And when we rebalance portfolios, we do that to balance the overall risk and maintain exposure to capture possible rebounds in prices. But we stick to our principles: discipline, focus, balance, and consistency, the whole time always remaining very humble throughout this process. I do want to thank you for listening in to our Minds versus the Market midterm election edition. I hope you found this information very helpful. If you do have questions, I would encourage you to reach out to your financial advisor for any information that might be helpful. And also, please take a moment to read these important disclosures. And again, thank you for listening.